Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott to discuss all things small cap. So big welcome, Paul.
Thanks, Paul. Hello, everyone. Good to be back.
Yeah, well, we've had another really busy corporate reporting day, sort of like characterized by the sort of the spaghetti western of the good, the bad, and the ugly. And on topping it off, really following on from last week, we seem to be having increasing investor fears of how agentic AI is going to disrupt lots of different sectors. It's been rolling through the market in different areas. So let's kick off there. We've got a couple of people asking about Moneysupermarket.com, the price comparison website. We've got MLS99 and we've got Harry both talking about it. They've come out with no news whatsoever. However, the shares got absolutely annihilated yesterday. I suppose you could shed a bit of light on what's been happening or what is happening.
Yeah, that one came up on my mid-morning screen for percentage movers yesterday, and I thought, well, that's strange. There's no RNS, so I did the usual, did a bit of Googling, asked my network, and basically there seems to have been a premium broker report, I think it was Morgan Stanley, just flagging that MONY could be disrupted by AI. But I mean, that's hardly a news story. That story's been decimating a lot of data kind of driven companies in the UK and the US for about a fortnight now. So it seems a little bit strange that there was a delayed reaction on that. And another of my readers actually flagged up a business, I think called Insurify. I think that's it. Not very original name, is it? Who are claiming that they're going to shake up price comparison websites with AI. So anyway, I looked into that, and all it seems to be is a ChatGPT front end on the same sort of IT that the existing price comparison sites use. So I don't see any reason why Moneysupermarket and all the others couldn't also add a ChatGPT front end to their businesses, because they're going to fight to keep their businesses going. So I do overall, I'm starting to get to think that some of this is overdone now, some of these fears of business model changes. But as we say nearly every week, because we've been discussing this for a long time, it's investor fear that puts me off. You know, it doesn't matter what is actually going to happen. It's the fear of what AI may or may not do that just the market's shooting first and asking questions later. But I am starting to see some interesting opportunities. I mean, I've got 4 or 5 ideas from the US markets we can maybe come on to. And also, I think Sage, of the software companies, Sage is starting to look quite good value. That's true. But the trouble is, a lot of these software and data companies were wildly overvalued, and they've only now come down to something that I would say is probably about fair, you know. So over to you, Paul. You have stronger views than me on this area, but let's see.
No, we're pretty close actually. I mean, I'm very much aligned with you. I think people like Sage, who are deeply embedded into an enterprise systems like ERP systems and accounting systems. Yes, there might well be, you know, sort of like new operators, but let's be clear about it. Companies are not going to throw out an established accounting package with all their mainframe systems. And actually, it could be very beneficial for somebody like Sage, simply because, first of all, you can reduce your costs because it will improve the product and take out some of the development costs because you can speed it up and launch more products. But more importantly, just sort of holistically in the world, okay, the software market is worth about $1 trillion, okay? However, the labor market is worth $50 trillion, okay?
Oh, that's an interesting
if you start thinking about, you know, extra sort of like, you know, total addressable market that software can move into what humans are doing at the moment. And if they just get one, you know, another trillion, I go from 1 to 2, that's doubled their portion. And obviously the humans goes down from 50 to 49, but that's 100% increase. And so you've got quite a lot of levers for people established like Spade. You can reduce your costs. You've got very sticky, high retention customers, and you've got a possibility to really improve increase your addressable market by taking more of that labor segment of a corporate as they automate. So I'm with you on Sage. Now, just on Moneysupermarket.com, which is the sort of specific question. The problem I have, yes, I think the main lever was on Monday because that's when they announced this Insurify through ChatGPT.
Okay,
and what that's saying to me is that you've got increasing supply of people offering insurance or will be offering insurance. So you've got, the moment you've got an oligopoly in the UK on the price comparison. You've got Go Compare, you've got moneysupermarket.com and Compare the Market, okay? And if you know, those are the main three anyway, where you get most of the sort of like your third-party data on where to buy insurance and all the other products. Well, if you start getting the same sort of thing, you get a fourth operator through ChatGPT, you get a fifth operator through Gemini. Then what you're doing is that the same size market is getting served by 5 people. So pricing's coming down and your share is falling as well. So that is why I believe people are spooked about the price comparison website.
Okay. Yeah, interesting.
Yeah.
Yeah,
okay.
I'm just looking at another one that I think is good value. Craneware. That's another software company. It's come right down to £15 a share. CRW. That is coming into buying range, I think. Yeah, there's definitely. So yeah, I'm in the mode of actually starting to look for bargains now. I think some of these things are probably oversold. Yeah.
Yeah. Well, let's keep on to Craneware because we've got a specific question from Sean Dent. He's asking about it because, as you rightly say, it's another high quality hospital enterprise system for hospitals out in the States, etc.
That's right. Billing.
It got a private equity approach, I think. That's 2 years ago at about 26 quid from
£26.50, I think it was.
Bain Capital or something like that. And anyway, the shares have come down. They're now below 15 quid. And if you run the same argument for Sage with Craneware, i.e. they're not going to be kicked out, then you've got those potential positives. But what's your view anyway? I mean, it's not stonkingly cheap, but it's definitely a very high quality company. What was your thoughts anyway?
Well, I've been saying for several years now that I just can't understand the valuations of software company. I know it's because they have recurring revenues and whatnot, but I think the whole sector has been overvalued and in particular chased up to ridiculously high valuations, and often for private equity bidders who really overpay, I think, for the growth. So this looks to me like quite a nice reset where valuations are coming back to what I would personally consider to be reasonable. So certainly Craneware, I mean, the numbers I've got, I mean, the shares have nearly halved from no, not quite, but down by over a third, you can see on the screen. The forward PE I've now got about 17.6 times. 2% dividend yield, and it has negative net tangible asset value. So I would say that's probably priced about right, if you ignore the fact that it had a bid. Now, what question for you, Paul? Given that the valuations appear to be kind of resetting to much lower levels, or it could be a spike down, we don't yet know. Do you think private equity will be such keen bidders and prepared to pay such high multiples in future?
Probably not quite as high because they effectively come to their price, don't they? And what they think the clearing price is for public, investors, public shareholders and institutions. And if the whole market's come down by 10-15%, they will adjust their multiple accordingly.
Okay.
What they think they can get away with. So that when it comes to offers, yes, because that's price related, price driven, what they think they can get as minimum clearing price, but valuation, which is what we're interested in with likes of Sage and Craneware. I could have a strong argument to say Craneware and Sage actually in the AI world, they could really benefit because the amount of extra labor that they replace in their customers, the key KPI to watch is NRR. Is a net retention revenue, i.e. if it's above 100%. And those ones are the companies who are basically expanding. It's that land and expand. And I think Craneware have got a great chance of removing more of the admin cost out of hospitals.
Yeah, I think that's a persuasive argument, actually. I mean, obviously, this is the big issue that we're all discussing in our investor networks, and where I've got my team of 4, they're all IT professionals. So they're constantly coming up with stuff and throwing it at me and saying, look at what we can do with this. And one of my team actually did a brilliant, short, concise summary of our last Vox Markets video. And do you know what, Paul? It was literally giving a 1-line entry per stock. and it picked up on the nuances. It actually was remarkably accurate. So, but these things are tools. They're not all knowing, all intelligent, I think. From what I've seen, they're tools that people who can get on top of AI and really start to improve their productivity and their output by using it like a virtual personal assistant, I think could command really big salaries. So I'm saying to my nieces and nephews now, when they ask me for career advice, I'm saying either become a gardener or a plumber or a plasterer or something, because you can earn damn good money if you're good at that, and self-employed, you can earn 100k a year and you cannot be disintermediated by AI. Or if you're going to go into AI, do it really, become an expert on it, where you can go into a company, transform that company, and then you can earn squillions. So it's very exciting, isn't it?
Yeah, it is. I've been given this similar message to my daughters, you see, because they're already sort of trained accountants and stuff, and they're a bit bored of it. But I've said for 2 years, the two long-term areas that if you're going to be able to be resilient against AI is either predicting the future, which is what you and I do, okay, because you go further out that the bots are, you've got an edge against the bots because the future's uncertain. Or shaping the future. And that's unfortunate. That's things like politicians, business owners, people making the rules. Those kind of people are the ones you've got most in, and you're going to have a good life, sort of stuff. So look at jobs and look at careers and look at things you wanted to do that either predict where you think the future's going, i.e. you can still make money and enjoy yourself, or actually shape what the outcome is. But I wouldn't fancy going into politics. Not with what's been happening.
I mean, no. I mean, there's literally nobody in my area. I know thousands of hugely talented and successful people in our network of investors and managers, and literally nobody expresses any interest at all in going into politics. And that is a fundamental problem, because third and fourth rate people end up going into politics, and that's why everything's such a mess.
Yeah. Anyway, let's stay on the AI agenda, but we've got Philly's asking about what's happening to the wealth managers and the IFAs today, because again, on no news, a really quite big FTSE 250, St James's Place has been absolutely whacked
down 12%, and that's the first move down it's done, isn't it? Looking at the chart, it wasn't until yesterday in a strong uptrend. One of my readers flagged this morning, actually. I can't see many other. Are there any other wealth managers down? And that might be something company specific, because I can't see any. Oh, AJ Bell down 5%. There is a news flag against that. No, nothing important. So I don't know on that. I haven't actually. I have noticed Synthomer is suddenly down by 32%. That's happened in the last. I think that is one we're bearish on because of its poor finances. Yeah,
okay, we'll come on to that in a moment. That's a different sector. But I mean, what happened overnight in the US? Was that basically a provider launched a new IFA wealth management AI app. Okay, really a similar sort of thing as in Insurify. And people are worried that this is going to, again, disintermediate a lot of the IFA wealth managers, which is exactly the wheelhouse of what St James's Place is, i.e. such that it'll allow one wealth manager to, rather than look after, say, 100 clients, they'll be able to look at 500 clients, for instance. And again, what you've got the fear is, I think, is that you've got more supply coming into the same size total addressable market, and so even when St James's Place and AJ Bell and all the other guys overlay and launch their AI agentic apps and stuff, then you've got more competition coming in, and I think that's what people have feared, is that because I mean IFAs, to be brutal, have had they charge 1 or 1.5% on discretionary funds, and hey, it's a nice job if you've got it, particularly when you're only recommending model portfolios or passives to go into.
But don't you think those sectors have been under pressure for some time already from race to the bottom on fees, and that a lot of people are just buying low cost trackers, aren't they? So I think they've already, mind you, I think St James's Place has been attracting inflows, hasn't it? Do you remember the ticker on that one?
Is it
Oh,
STJ?
STJ. Yeah, I
Yeah,
could have guessed that, couldn't I?
yeah.
Yeah, that is. Yeah, funds under management were up 16% when it last reported in January. I have heard some issues about their modus operandi, but it's just something I heard secondhand. I don't know what those issues are. I think there are some unhappy clients, but they're attracting inflows and they're managing what, 220 billion. So seems to be a successful business. But yeah, maybe, as you say, we're all just guessing, aren't we, which sectors are going to get hit next? And apparently the energy suppliers could be the next sector to be hit. There was some startup AI thing that was in the Times in an article that one of my readers flagged to me yesterday, I thought, or the day before, who apparently have already got Fevertree and Boohoo using their services, where they cut out the wholesale markets and somehow use AI tools to deliver savings on the utilities. So I think for that reason, I'd be steering clear of these energy supply companies as well, because they're rather lucrative environment that they've enjoyed for the last 3 or 4 years. That could be the next shoe to fall, or whatever the phrase is. What is it that falls? Is it a shoe?
Yeah,
No,
shoe to drop. Shoe to drop.
Shoe to drop. Yeah, yeah.
Well, the shares of U Group have done very well, which is the
they have.
the energy
But
supplier. I mean,
you know, but what I'm flagging is that may not necessarily continue if people suddenly say, "Oh my God, that's the next sector AI is going to hit." So we've got to be terribly careful at the moment, haven't we?
I mean, you know, we talked about it last week, and I think there are going to be a lot of losers, and I think there's going to be a lot of companies that will be able to have a lot of hybrid models. Part of it will lose, some of it will gain, etc. The ones I would have most confidence in, and I wouldn't say it's 100%, I'd only say it's like 75%, are those embedded B2B enterprise software companies, your Sages, your Cranewares. I mean, you know, SAP, these kind of people, because they're going to benefit from lower cost and increasing total addressable market as they they replace people at the. I mean, let's be clear about it. Me and you, we're finance trained. I mean, accountancy teams. Wow, God. I mean, those guys can be seriously, you know, streamlined if you get the proper, you know, IT sorted it out, and also, you know, lots of accountants. You know, you've had basically who was it, Deloitte this week, saying it doesn't want its auditors now to do normal audit work. It basically the low level, the first year, they're going to train them, and then to get them to a higher level, such they can actually do better than, you know, more educated work than normal AI, and also just your standard transactional stuff that's been outsourced to places like India. Well, I mean, I think that's going to go. I mean, if you're an outsourcing company in India, you're going to get absolutely annihilated if you're just doing transaction processing. I mean, you know.
Yeah, I mean, actually, one of the 5 companies that came up on my sweep of NASDAQ last night as potential buys was the accountancy firm Intuit, which does QuickBooks, and it also, I believe, it owns MailChimp as well. Now, that is really coming into quite interesting buying range at $424. You know, it's starting to look like a value or GARP, growth at reasonable price share, and also Workday. That's another one readers might want to have a look at. That came up on my screen of NASDAQ last night. And maybe even Adobe, although they could possibly be disintermediated. And 2 others for you, seeing as I'm doing them. Netflix, I think, is now looking reasonable value. That's plummeted. And PayPal. PayPal looks crazily cheap. It's on about 6 times free cash flow. So there you are. There's some US stock ideas. But I'm not an expert, so you obviously need to properly research those, and they could be rubbish.
Okay, let's go to the one you mentioned, Synthomer, basically a chemicals business.
Oh, yes.
I think it's highly indebted, isn't it? And you were saying, I'd noticed it. The shares have absolutely tanked today.
Yeah, no, that's happened in the last hour. So again, I just do a percentage rises and fallers screen on ShareScope constantly, so about every hour, and I pick up the big fallers. Now, we've been amber red on this, which is a warning since over a year. Well, a year ago, March 25, we've been warning about the balance sheet, which is the debt is a massive problem there. It was 4.8 times EBITDA, debt of 575 million. That was as at December 25. So something's happened today. I think there's a kind of, here we are. It's down 38%. Whoa. Statement potential refinancing. Oh dear.
Oh, okay.
So there you go. process of working with lenders to refinance its existing debt, giving consideration to a range of options. So it sounds like they've got a discounted placing coming, doesn't it? So, you've got to avoid these highly indebted things, because you just get something like that happening. It's already done one fundraise a year or two ago, but it was nowhere near enough. The balance sheet's awful at Synthomer. So there you go. Another high-risk, highly indebted company shatters shareholder value. So bad luck to any holders, but, it's pretty obvious it needed to do an equity fundraise, I'm afraid.
Yeah.
So,
no, well spotted. I mean, the balance sheet's been particularly weak for some time, and
it has.
I mean, if you go into it eyes open, that you could either multi-bag or multi-lose.
Yes. Yeah. Precisely. Yeah.
Yeah.
I mean, your 10 baggers often come not often actually, but so your 10 baggers is often the starting point is financially distressed, isn't it? And then it turns it. I mean, look at Sargo rather. That's been a fabulous one recently. I mean, I've been saying for years to anyone who'll listen that the balance sheet actually wasn't that bad, because the debt was secured on these 2 cruise ships. It was asset backed. I've been proven right, but I was about 4 years too early. But that's a good example of a multi-bagger this year, I think, or even certainly in the last year. It's 4 or 5 bagged as trading improved, and people suddenly just started saying, forget the debt. Look at the EBITDA shooting up or whatever. So well done to people who bought into that. I missed it, unfortunately.
Well, I interviewed Richard Crowe, Cotley Rebel, a couple of weeks ago, and
he loves it, doesn't he?
Well, he specifically gave you a big pat on the back and thanked you.
Oh, did he?
You were the reason why he had to look at it in real detail, and
that's nice to know.
That he's absolutely cleaned up, and I think it's now his equal first position at about 30% of his portfolio. Amazing. Because it's just increased so much, and he did the same. I remember when Rolls-Royce happened about 4 years ago, because people were talking in the bottom of the pandemic that there's nothing flying, they're going to debt problems, the pension's a real issue, it's going to have to do a huge rights issue, and I think the new CEO came in and said this is a burning platform, a burning whatever it was, and that was the point that it all turned. It went from about 70p a low to about £7 or whatever it is now. So you're right. The problem with going with deeply indebted businesses is your hit rate goes down, because for every one which goes five or 6 bags, you probably have at least 5 others or 3 others which go to 0 or near to 0. And as long as you're happy with a really low hit rate and you can actually stomach that volatility, I can't. I like to operate at a higher hit rate. I can't do less than a third or less than 50%. I mean, I just feel as though it's just gambling as much as anything. But hey, if you hit the right home runs, then clearly you do very well.
Yeah, that's right. And Richard is particularly good at spotting turnarounds. I think he's just got that's almost sixth sense of, they don't all work, obviously, but he's got, this is why he's so widely followed, because he's got an outstanding track record on these things, and he's just proven it again with Saga and Goodwin. So definitely a man to listen to.
Okay, let's look at another one which is pretty much severely indebted, 3.5 times EBITDA. We've got Graham. He's asking about Iomart, which is a UK data center stroke IT services business that has unfortunately overgeared itself and came out with an impromptu sort of net profit warning basically this morning
today,
and it's not in a good place. The shares have gone down. Is this a potential turnaround for Cotley Rebel, for anybody who's brave enough, or is this something you should steer well clear of?
Well, I mean, same with this. We were amber red, which is a warning on this share for the 4 times for the last year. During which time it's gone down from 46p to 17p. So again, our warnings on this, a terrible balance sheet, absolutely diabolical. I did look at this morning, and I think it's covered in red flags. So I've actually reduced it further from amber red to red, which is almost our highest warning. We do steaming turds as well, but that was mainly for the the Bitcoin treasury ramps. So we got that spot on, I'm pleased to say, but we don't get everything right by any means, nowhere near. But this one, you've also got the CFO has just walked today. That was announced. The auditors resigned not long ago as well and are being replaced. Now, I don't know what the chain of events in that was, but you can see there's a lot of warning signs around this. Now, it was a profit warning today. Forecasts have been reduced quite significantly by Cavendish. But the worst thing is the balance sheet. Net tangible asset value is minus 81 million, and it had 92 million net debt. Now, I thought, well, there must have been going concern warnings, but amazingly, the last accounts had a clean going concern statement saying that they've complied with all their banking covenants. So, I mean, very strange situation. But at some point, the bank manager is going to realize this thing, oh, we're actually on the hook here. We're not really debt, we're quasi-equity. And that's when I think the proverbial could really hit the fan. So personally, I wouldn't touch it unless and until it's done a substantial equity fundraise, which the bank could well insist on. So no, I wouldn't go near it. It's just too risky. It's like you say, why take on that level of risk where you could wake up one morning and find that they've just done a massive, huge, issued billions of shares for a penny or something. I mean, anything can happen when you've lost control of the debt. Oh, it's not a good, being in the equity is not a good position to be in.
Yeah, no, I totally get it. I mean, I've been owning this one for 2 years and just seen it go down. Okay, and the reason why you're exactly right. I mean, the reason why I bought it, I think it was back in. So that's right. It was about 2022. I first purchased it at the start on the back of when AI was sort of first really sort of introduced, because they do data centers and they do IT services in cybersecurity and Microsoft, and they do a whole bunch of stuff that is really AI focused. And I thought, okay, well, these guys, because they've got 12 data centers in the UK, it's going to be valuable to them or valuable to somebody else. And that was a sort of investment. Anyway, through sort of like, perhaps not very great management sort of like, actions and lack of productivity, lack of actually bringing new products on, they haven't, that thesis just didn't work. The sector was good, but the company was poor. And then what they tried to do, the management team, Lucy Dimes, the previous CEO, she basically did an act of desperation. She bet the farm buying this really expensive sort of like AI Microsoft sort of like software provider called ATEC about 18 months ago, 2 years, and it was about that. And then they, on the back of that, it was just hugely she overpaid massively, probably by, it cost her about 57 million, I think it was, and it shouldn't have paid more than 35, and that would have been top dollar. So she hugely overgeared geared it, and then with that debt, rather than raise anything at about rise in the equity about £1 or £1.10 to help pay for it, she basically just did debt with some HSBC and I think Clydesdale and people like that. So they've got this RCF and loan facility which goes until, I think, with all of these sort of like covenant waivers, or should we say quite stretched covenants. So they're not going to breach. That's why they got through the going concern statement, because they're quite wide on the basis that they'd just started closing that when it comes up to renew, which is in June 2027. So you've got a bit of spare time, but once you get into that 12 months, you get the ticking that you've got to refinance this. And I'm with you. I think what's happened, I looked at the results today and thought, well, the new management team and the new guy seems to be doing a decent job. However, they've had a poor December, they've had a poor January. When all these AI apps are coming out, if they can't make money when it's actually going gangbuster in the sector, when are they going to make it? And I just pulled the plug this morning. I just thought, right, okay, clearly I've got this is something that hasn't been able to get traction in the sector, and its competitive moat is diminishing quite rapidly because of the churn. You can just see it's losing customers. And I just thought, well, this debt, and it's the logic that you have, the debt, they're going to really struggle unless they're bought by somebody and saved, and they're definitely very cheap. I think they traded about, I don't know, if you did the oval, probably 6 times EBITDA, 5 times EBITDA, and it'll go for 8 times easy. So they're definitely cheap. But to have a whole thesis based on somebody coming and saving you is a pretty sort of remote. So I just bit the bullet and just said, look, okay, it may turn itself around, but the Damocles sword of that refinancing over the next 18 months is just, it could potentially annihilate you. So I thought, okay, I'm moving on. I've had enough. My investment thesis didn't work. The company couldn't execute it.
Yeah, fair enough. And also, I think with data centers, they have quite a lot of ongoing capex. So I think the kit and all the wiring has to be replaced every 2 years or something, doesn't it? So, which I mean, I haven't looked at the capex spend at Iomart, but I would certainly want to take EBITDA with a pinch of salt. And of course, the bank covenants will be based on EBITDA, which for something that has to do a lot of maintenance capex is just the wrong measure to be using. So I think at some point you could well have a crisis in the banking sector when they finally realize that lending on EBITDA is actually not a proxy for cash flow, and they've been doing it wrong for about the last 30 years.
Well, they do it more than that. They do it also on interest cover, don't they? I mean,
Oh yes, there's several on there, but that's right. Yeah.
But you're right. Some of them it's net assets, which with Iomart they don't have any, so that's gone. And then it's basically EBITDA and PBT, and given their PBT is negative at the moment, and that that was their estimate of negative, and they're going to go below their estimate for this year. That's they're going to struggle in my view. But anyway, let's I wish them the best, but I'm out. I've had enough. I think that's just a bad one.
Yeah, fair enough. Yeah.
Okay, we got Diane. She's asking about basically we talked about the energy sector hasn't yet been come up as a sector that's been hit by AI. Yeah. Diane's asking about gaming, basically, and there's one, Frontier Development, for instance, because Alphabet, Google, the Google parent, released its basically Project Gemini. I didn't realize this until, she sort of alerted it to me. And this basically is an AI-based tool which basically develops using, effectively use text, and it converts or creates an environment that people can game in, and to basically, a virtual environment where you can basically have your own avatar and all this sort of stuff. And it was just your sort of views on Frontier Development and gaming more generally, because Frontier Development shares have recovered really well, and I thought as a bit of a star. But have we got the sector potentially being impacted overlaying it?
I don't know. I mean, Frontier Development, just looking at my archive here of our comments, we've covered it 6 times in the last year, and we've been amber green, which is positive, 4 out of 5 stars on it every time. And the shares have done really well, as you say. A year ago, it was about £2.30, and we were amber green on it then on 15th of January 2025. Strong turnaround with its H1 results. So we've been flagging this positively ever since. And it's now up to about, last time we looked at it actually was 14th of January. H1 trading update this year, it rose 5% on that. So it looks a nice business, actually. Several games have performed strongly. I mean, generally the problem with the gaming sector, as you know, particularly the smaller companies, is they're highly dependent on how each game lands and sells in the first few, maybe even the first few weeks. That's when they get there, but they've got to do all the product development spend up front, haven't they? How the sector is changed by AI beyond my pay grade, Paul, I don't know on that. But
you'll have to ask you'll have to ask some of your team, because they're experts in all this, aren't they?
Well, funnily enough, I have had a total punt, and this is a complete reckless punt, not like me, I hear you say, on something called TinyBuild. And I had a particularly enjoyable, very, very boozy, burgundy-fueled Christmas dinner with a whole bunch of my investor friends in St James's. And one of the guys mentioned, who's very shrewd, very experienced, retired city guy, quite senior. He said TinyBuild is interesting because they've got this new game that's been delayed and delayed and delayed, so it hasn't been launched yet. But apparently, one of my readers pointed out it's the number 7th most requested new release on Steam, which is the big platform. So they could have an absolute blockbuster there, but they haven't actually been able to release it. So there you are. If you want a total punt, so this for me is binary. I'm either going to lose, it'll just go bust and I'll lose my money, or if this new game comes out and is as good as it's made out to be, we could have interesting upside on that. But that is a really, really, not for widows and orphans, a total high risk punt.
Yeah, I would say when it comes to sort of gaming, you adopt the same sort of investment principles as we used for enterprise, B2B software. Okay, so if you're in the
Right.
gaming industry, right? Okay, your customer typically is a consumer, so it's not a business. Okay,
Yeah.
right. So it's quite easy for consumers to flip from one game to the next if they're a keen gamer. Okay, unless you have huge sort of like liquidity in that game, and that's what attracts you. You've got literally hundreds of millions of people like Grand Theft Auto, and there's lots of others where you've got these massive games with so many players on it all the time, and that's your USP. And so people won't change to new products because they've basically got that sort of like extra liquidity. But again, coming back to the investment logic we used before, you're going to get, with this new Project Genie, you're going to get more people being able to create very, very convincing and very capable, games for consumers. And if you're a gaming business that does one-shot games, i.e., it's a single player game rather than a multi-massive, multiple play, million people playing game. You haven't the switching costs are really quite easy to move. And therefore, I would say, personally, if I was going into gaming, I would go for the big boys who have got these huge franchises with massively multiple matches. So basically, I think Activision Blizzard is owned by Microsoft, and I think Take-Two has got Grand Auto Theft and people like that. So I would tend to migrate to those guys who have basically USPs and huge barriers to entry, but single shot, single game, single player type of games are going to get a lot more competition coming in. Of a lot cheaper. And so unless you've got a franchise to keep people coming back, you're going to get price competition, basically, isn't it? Simple as that.
Yeah. And Steam, I think, is putting pressure on them as well. I've heard that they're squeezing the margins. Although, I mean, it's not my sector. I'm certainly not an expert in this at all. But I have heard, I keep my eyes and ears open, and I have heard that apparently a lot of the independent game developers like Frontier Developments and like TinyBuild, they already use pre-packaged sort of physics engines and things, don't they? So I think their cost of development has also come down quite a lot. So I'm not sure how that all fits together. It's generally not a sector I'm particularly keen on, other than for the occasional reckless punt.
You're an expert. Another area, along with reckless punts, another area that you're an expert on is seeing machines. Now did they come out with a trading update today or some sort of results? These guys do these visualization systems that help drivers basically stop nodding off and making sure it's all safe. And it's been mandated, isn't it, by the Europe to come in by July of this year. Anyway, what's your views? The shares actually have ticked down by about 4%.
Yeah, it's down very, very heavily this year to date, but it really spiked up, as you can see from the chart there. It went from 2p at the lows to 6p. It's now come down by a third from the high to 4p. Now, this one, actually, I can crow about this a little bit because we turned bullish on it on the 2nd of May last year when it was 1.96p. We turned amber green on it, just saying, look, there's a good opportunity here from the EU requiring fitment of eyeball tracking equipment, and Seeing Machines is one of only about 3 credible companies in the world that can do this. So they reiterated and anyway, they went up from 1.96p up to a peak of about 6p. I sold mine personally at about 3p, so I made a 50% trade on it, but then watched in dismay as it carried on up. But it's very tricky to value, and the update today was a Q2 KPIs update, only 13% quarter-on-quarter growth, which I don't think is good enough, but it is up 117% year-on-year. This is units, the number of units fitted, and it earns a relatively small royalty, I believe about $5 or €5. It's all the manufacturing's outsourced and so on. So they get, but the key thing is in July 2026, which is obviously getting close, that's the mandate date where these things have to be fitted to new vehicles made in the EU. So what the bulls are betting on because there's no established track record of profit or positive cash flows, just burned cash for about 20 years. What the bulls are betting on, and it's a perfectly reasonable thesis, is that from July you'll see an explosive upside in the number of units being fitted. But we're in that uncomfortable sort of no man's ground where we can't really be sure what the numbers are actually going to be. That's the issue. And I think this is what's causing the wild volatility in Seeing Machines share price. I do feel I'm tempted to have another dabble in these. I've got to say, 200 million market cap is quite a lot when it's not actually yet proven that this is a viable business, and it's been going for 20 odd years. So you're having to basically buy it on faith that the EU legislation will lead to a massive uptick. But the trouble is, you need inside information to know if that's really credible or not. This is the problem. And they have been promising a lot for 20 odd years and repeatedly failed. So it's a tricky one. I have heard rumors as well that one of the big players might come in and buy it. It's got two major industry financial backers. I think Mitsubishi is one, and Magna, is it? A Canadian thing. So it is credible because it's got that credible big industry backing. So it's just not for me because there's too much guesswork involved. But I think the bull story, obviously at 4 pence, is more attractive than it was at 6 pence, isn't it? On a value basis. So I can't remember your view on this one, Paul. Over to you.
Do they have to raise any more money? I mean, they've got a bit of debt at the moment, according to share.
Yeah, I think they're all right. They keep reiterating they'll be cash flow positive later this year, but they don't say on what basis they'll be cash flow. They do have a track record of over-egging it with the RNSs. It's one where I always check everything. I remember a few years ago they gave they said net cash and they just gave the gross cash figure and totally didn't. And I really tore a strip off them. I actually talked to management and said, "Look, you're deceiving people. You're giving a false figure." And they said, "Oh, we didn't mean to." Mislead anyone. And I thought, well, convertible debt isn't really debt. Yes, it is. So I don't particularly trust the RNSs from Seeing Machines. That's another issue with it. But it could come through in a few months' time. So I've walked away from it personally. I don't feel I can judge really because it's unknown.
Yeah, I think one of their bonds is coming up to mature later this year, about 6 or 7 months. Yeah, and it's quite a big bond, and I think that's why they essentially sold forward some of their sales and got on royalty sales for 3 years to get cash. But it's still a drop in the ocean in terms of what they need to raise to refinance. So I'm pretty certain they're going to have to basically do a fundraise in the next 6 months. So as long as you've got a long-term time horizon for this, and it could well be that they refinance very easily, because by the time, as you say, by the time they get to July, when they're racing away and doing really well. So and people be stampede to get in. So, but
good point.
That's just a bit of a leap of faith for me. So I'm probably going to be. I think it's very interesting technology. I'd like to speak to the management team. So if they are out there, it'd be nice to touch base and find out what the resilience is in that business model.
I think actually I did have a chat with management because I was highly critical of them about a year ago, as I mentioned. And they did, the PRs, I think, reached out and said, well, would you like to run these points past the management? I said, yeah, absolutely. Because I always believe in a right to reply. If we slag off a company, and they reach out and they say, well, we'll talk you through those points. I'm very, very impressed by that. And I think that was why I did turn positive on it. I thought actually the story here is pretty good. Yeah. So we'll see what happens. Yeah. Good luck to the bulls.
Okay, let's move to the life sciences sector. Grant's just alerted us actually. hVivo apparently is up about 40% over the last 3 or 4 days, but is up 20% again today. Have you seen any news? I haven't seen any RNS at all on this one.
Yeah, I spotted. I asked my network, and one of my readers discovered that it's got a large contract that's on hold with a customer called Lithia, I think.
Iliad Biosciences.
Iliad Biosciences, who 2 or 3 days ago announced a large equity fundraise had been completed, I believe. So people are now guessing that's why it's gone up. Well, it's up 28%. No. up 24% today, and it was up 18% yesterday. Now, I should disclose, to be fair, I've sold half of mine literally in the last couple of hours. I didn't know it was going to come up in this discussion, but the reason I did that is because you saw a similar blip up, as you can see on the chart there, in December. It doubled, and I sat there and did nothing, and then it came nearly all the way back down again. So I thought, well, I'm not going to let that happen again. And this is just in my trading account, in my Spreadex account. So yeah, I've sold half at about between 8.1 and 8.6, I think, earlier today. But I'm going to run the balance for the duration. So that was nice to bank some profits on something.
Yeah, I think you're right. If Iliad have actually managed to get funding, because they announced, I think it was a letter of intent about 18 months ago to do a very large phase 3 whooping cough vaccine challenge trial with hVivo. And this is enormous, this one. But they did say at the time they had to get funding. And because of what's been happening out in the States, it's been very tough for biotechs to get cash. However, if they've now got the funds, then that letter of intent, in theory, should convert into a firm order. And I think this is a really, really significant deal. I mean, I don't know what the turnover is on it, but I would guess that it's it's 8 figures. It's not 7 figures. It's 8 figures. This challenge trial.
Yeah.
So that's why. So yeah, great. I hadn't spotted that Iliad had actually got funding, but that's very, very positive for the shareholders, and well done to the management team.
Yeah, so we need, what we need really now is an RNS from hVivo itself, confirming this. And the valuation now, are including today's rise, the valuation's now about 60 million. Yeah. I mean, I did catch these near the lows without wanting to sound like a smart ass, but I bought them when I bought them when it was about, because I get so many things wrong. It's nice to crow about the odd one that works. But yeah, when I was buying, it was about 35 million market cap, I think, and it had about 14 million net cash. So it was nice, risk reward at that level was pretty good. But it is, of course, forecast to be loss making currently, but not ruinous amounts of losses. So that's why I'm happy to now I've taken some risk off the table. I've basically got my remaining position almost for free. So I'm just going to run the balance for long term for a couple of years or whatever and see what happens.
Good. Okay, good. Let's go to consumer products. We've got Stephen Griffiths asking about PZ Cussons, which I think came out with some results or a trading update today. Shares are doing very well, up nearly 10%. What's your sort of latest on this one?
Yeah, we like this one. We've been amber green, 4 out of 5 on this one now, 7 times since June last year. And it's very nice update today. Actually, it was a strong performance, broad-based growth, they said, and ahead of expectations, which we flagged at about 7:30 this morning to our members. Operating profit guidance has been raised 5%, so you'd expect the shares to be up a similar sort of percentage today. I think it's up a bit more than that. It's a nice, very geographically diversified a group of businesses of mainly making personal care type products, and it's had various issues over the last few years, but I think it's pretty much resolved them now, and they've concluded the strategic review. They're doing a capital markets day tomorrow. One of my readers asked me to complain about that, saying it's only institutions get access to it, and I think a lot of private investors would like to be able to join capital markets days remotely. I think they should be broadened out to everybody. Although maybe the institutions there don't want to be on camera or recorded or whatever, I don't know. But we think the valuation remains undemanding on PZ Cussons. So yeah, we like it and we're staying positive on it. And you get a good yield as well, about 4.5% dividend yield. They've paid off quite a chunk of the debt with the disposal. So it's no longer distressed, but it's priced as if it was still distressed. So we think there's further upside on this. And I'll have to consult Lord Lee, the peer of the realm, who's a big bull of PZ Cussons. He used to be on the board, I think, as well, years ago. So I'll get on the blower and find out what Lord Lee thinks.
Good. Okay, let's move to the building sector. We've got Drew. He's asking about VP that I think came out with a trading update. He says, and he reckons, is this a buying opportunity? The shares must be down, I guess. These guys basically do equipment equipment rental for infrastructure and construction in the UK. They've got their, I think basically their consumer plant hire business, Brandon Hire, which is being right-sized and restructured from about 120 stores or 100 stores down to 40. So they're going through that. What's your take on it? Is this a matter of when, not if, or is it something you should steer clear of?
It's very disappointing, and I'm sorry to say we got this one wrong. We were positive on this last year, amber green, and then in July we went up to green because, I mean, the valuation metrics look so good. So on the 6 months ago, it was offering a dividend yield of over 7%. A good, decent balance sheet with only relatively modest debt for an equipment hire business. Owner managed, of course. The founder owns 50 or 51%, is trying to sell, but has tried a number of times. But I think he's not been able to get the price he wanted for it. Yes, we did have a disappointing update today, which is a pity because in November it said H1 was solid despite challenging markets, a cautious inline. There were some kind of slightly wobbly elements to the November H1 results last year. With hindsight, we maybe should have gone a bit more cautious on the shares. But anyway, it's not a disaster. It's down 12% today, which is, could be worse, couldn't it? And yeah, Brandon Hire, I was really quite shocked about that, but I don't think that was new information. I think it's already said it's restructuring them, but closing 60% of the branches, I mean, that is brutal, isn't it? And that's got to come, I would imagine, with a lot of exceptional costs. All those leases, they're probably going to have to pay the landlords to take them back. So, and laying off, I think, 400 staff obviously is brutal for the staff and comes at a cost. And is this a benefit for Speedy Hire? And what was the other one called? Change its name. HSS. It's
Pro Service. It won't be a benefit for Pro Service because they haven't got it, but it could certainly be a benefit for Speedy Hire.
Speedy Hire, yeah. So no, rather disappointing. It was between, depending on what figure you use, VP's full year profit warning, and this is for March 26, so it's Q4 profit warning is pretty poor show. I think they must have been kind of maybe holding back and hoping to catch up, which has now become clear they won't. They said that a disappointingly muted January, especially in the water sector and in general construction. So which combined with, we've had a couple of quite slightly wobbly updates today from house builders, means that our hopes for a recovery in the house building sector and the building supplies sector yet again seems to have been deferred, doesn't it? Really not any particular signs of green shoots, I would say. And that's confirmed by VP today. But obviously you've got to get in ahead of the green shoots. That's the thing. As an investor, by the time you wait for these green shoots, these things will be 20-30% higher, won't they? So I think to a certain extent we need to take a bit of a risk. But yeah, it was disappointing from VP. So sorry, we were a little bit premature in expecting a recovery there, which just hasn't happened yet.
Yeah, I mean, personally, I would lean on the side of it's a buying opportunity rather than to sell.
I would actually.
The reason is because I think about 70% of their revenues come from infrastructure, your electricity, your transmission, your water, your rail, and construction. And what was quite interesting, I think the last trading update from Van El, they basically said the permissions, for basically building safety regulator Gate 2, which is for these big high-rise sort of blocks of flats, etc., have actually, started to flow through. So you're going to start getting construction now because that Gate 2 allows you to build trenches and foundations and this sort of stuff, which VP does lots of it. The problem, you come back to the square in the circle with the housing market in particular, is that the demand is not there yet, okay? But we're starting to see increase or blockages in the supply side with building regulations and permitting and stuff like that. We just haven't got the demand, and that's the thing the government needs to sort of like tick up. People are saying that they're seeing green shoots at the start of the spring selling season, but they always see green shoots at the start of the spring selling season. So whether it'll have long legs onto it. But no, I would, if I was erring, I don't own VP. I do know it's a quality plant hire business and it's got very good positions in infrastructure. And let's be clear about it. We're building reservoirs, or we need to build reservoirs. We plan to build reservoirs. Likewise, You know, when it comes to transmission, I mean, electrification's massive. Rail, we've still got plenty to do in rail. Roads, probably still got. I mean, these guys are positioned well when it starts, and they get good operating leverage. So, if I held, I certainly wouldn't be selling. Whether I would be buying, I probably wouldn't be buying, given the timing. But I think they're cheap. They are definitely cheap for a good quality business.
I think you're right, actually. I mean, I focused on the short-term negatives, but I mean, they did say also with the water sector, is it AMP8 or something? They said a lot of those contracts have just been deferred, so they've slipped from March 26 year end into, but they're coming through. It's just that the work has slipped basically into the new financial year, March 27. So yeah, I think, and it looks to me, you know, only down 12% on a profit warning, which was roughly a 25% miss. The market is half looking through this, isn't it, actually? And I agree. I mean, it is a quality business and it's cheap. So yeah, I think I'm with you. I would probably, if you force me to be a buy, a hold, or a sell, I'd probably be leaning more towards actually being a buyer of this.
Yeah, no, me and you, yeah. Okay, let's go to one of the house builders. We had Gleeson, MJ Gleeson, the Northeast stroke Midlands house builder, and also does land development, etc. Didn't come out with a profit warning, albeit they did say they need a really big blockbuster last quarter to hit their numbers. So everybody interpreted it as a sort of like a semi profit warning. The shares are down 9%. How did you interpret it?
Yeah, I went through this a couple of times through the RNS in detail, and I thought this is a profit warning. I'm sorry, it just is. They're kind of saying, and these are my numbers, but they're kind of saying we're probably going to miss about 80% likely to miss the forecast. But if we have a barnstorming spring selling season, you know, we'll hit the numbers. So that's the way I read it. But that's not the end of the world. Again, you're buying shares to own all the earnings in perpetuity, not just this financial year. And it is very strongly asset backed, right at the affordable end of the market, really, really cheap selling prices. If they bring back Help to Buy or some sort of targeted, which we've heard strong rumors of recently, haven't we? Then Gleeson would be one of the obvious ones to benefit. So I mean, we're stuck records on this, aren't we? We're anticipating a recovery now for about 2 years. That hasn't happened so far, but it's not a disaster. I mean, the H1 results today were, I mean, barely above break even, really, only £2 million PBT, but I think it's an H2 weighted year. June year end, isn't it? Early signs of a recovery in demand is one quote. But the bulk market, which is where they sell, you know, a whole housing estate to an institutional investors, they've said the bulk market has softened further. So it looks like the infrastructure, you know, the buy to let bulk buyers are driving a hard bargain now. And Cavendish said we will review our forecast shortly. So that's basically telling you they're a bit too busy to put a profit warning out today, but it's going that way, isn't it? And the market has taken that in its stride and said, okay, we'll mark it down 8%, which I think is about right. But again, I think for people who can take a medium term or long term view, I think it's attractive. The whole sector is, I think, that with Barrett Redrow as well, which also updated again. If you can look through the noise and the short-term disappointments and whatnot, you've got that lovely asset backing. Sooner or later, these things should re-rate, and it could be quite fast and quite a big re-rating when it happens, you know. So I would definitely want some exposure to this sector.
Yeah, I mean, mainly the big bulk buyers are the housing associations. Yes, you might get some of the pension funds doing some funding for it, and you might even get Granger. But I know from Granger, because I own Granger, they're going ahead with their building process, their building, you know, planning, promotion, and all that kind of stuff. And so it's mainly what we're talking about delays is mainly the housing associations. And frankly, it's the government. Is it the first budget they said, oh, we're going to give £35 billion to the housing association? How much of that has actually gone down to the grassroots? I bet naff all. And that's the problem, is that they've been saying these things, but not actually there's no action behind their talk. And if you're not giving the money to the housing house, and the other thing about the housing associations is that they've got huge cladding provision, you know, liabilities.
Oh, that's a good point.
They need some money for that as well. So hey, it's a bit of a chicken and egg, but at some point in time, it's an easy one for the government. You know, sort the housing, you know, industry out, and therefore you get multiplier and the wealth effect, and people are happy and increase your votes. I mean, it's a no-brainer, isn't it?
Yeah, I think it's like with all these things, it's so difficult to actually implement and get these things done, isn't it?
Mm.
For that. And didn't I read somewhere as well? I think some American private funds were putting money into this area because I mean it's a good way to get inflation proofed future revenue streams, isn't it? Really, we should be having pension funds, insurance companies pouring money into house building. It's strange in a way that they're not.
Yeah, I mean the ones in the US, the KKR and Brookfield. I mean they've been putting a shed load of money into it, and I think there's lots of them who do residential sort of stuff. Okay,
Yeah.
anyway, let's move sectors. We've got Questaware and also Nick both asking about Warpaint, which obviously we've talked about a lot. Do they come out with some results just recently? I think they have a profit.
Yeah.
Did they have a profit warning, and then the shares went up?
They did, yes. I mean, I'm sure you'll be able to get the chart up. I mean, these have been absolutely clobbered. I mean, wind back about a year or so, and everyone loved it, rightly so, because they kept beating expectations. They were rolling out the makeup ranges to numerous retail chains. Yeah, look how it's come down, 500 or 600p it was, and bottomed out around £2. So yeah, the latest on this was that it put out a profit warning on 10th of September last year. Not disastrous, but the profit guidance was reduced a fairly hefty amount, actually, by about a third. Well, anyway, they warned again on the 9th of February. That was 2 days ago, Monday this week. So they've also sort of mentioned a small asset acquisition from the administrators of a small makeup brand. So looks like it is consolidating some other products on the cheap. It's a tough sector, it seems, makeup is at the moment. This was, it was another profit warning, but not a disastrous one. And the revised EPS, it was 19.7p. It's now 17p. So again, not a catastrophe. And I think a lot of people bought it had a relief rally on Monday, but I think it's actually giving that back now. I was very bullish on it when the earnings were consistently beating and rising, but it's now actually, earnings are falling. So obviously the facts have changed negatively. So I'm not massively bullish on it now. To me, it looks priced about right. But the outlook comments were good. They did say for the next year they have further customer rollouts, which they're going to confirm in April with big retailers. Higher margins are planned. And quote, very well positioned for the future, unquote. And it is owner managed by Sam Bazzini and his business partner. And it does expect organic growth to return in 2026. So a bit of a mixed bag. You had another relatively mild profit warning, but you had pretty bullish outlook comments. So I think for the time being, I would say personally, maybe priced about right.
Yeah, I mean, I'm with you. I'd be cautious because when you look at the like-for-like sales in their existing business, they went down by about 5 or 6%. And that says to me their competitive moat, their brand allure is actually losing its edge, not gaining it. When you get like-for-like sales down. Now,
you're right. And the brand architect's acquisition was what caused the revenue to be up 3%. But if you strip out that brand architects, it was down 6-7% organic. But they do blame some specific factors, which are actually fair enough. Like one customer, I think, went bust, didn't it? And they lost
body care.
That was it. They had a bad debt from them, and also I think a lot of the stores were subsequently closed. So that's fair enough. That is a one-off hit. One of the main things that has put me off a little bit, and this was 6 months old, this information, so it's nothing new, is that they're really heavily dependent on one major European customer, which so the client concentration here risk is quite extreme. So not as keen as I used to be on it because the facts have changed.
Yeah, and also I think the reason why their gross margins increased, they didn't say why, but I think it's just because you're buying in US dollars, the dollar's devalued, so you increase your margins in the short term. only in the short. So this is that
True.
temporary effect. And so, you know,
Yeah, that's a good point. I mean, so I've heard conflicting information on this, because some companies are saying that China is, because the Chinese are struggling to sell gear into the US, they're offering much keener, more competitive prices to European buyers. But somebody else told me, another credible source, a newspaper or whatever, said that the opposite was happening, because the Chinese kind of had to absorb some of the costs of US tariffs. They're actually charging more to European customers to make more profit out of European companies. So, I mean, which do you think is the case, Paul?
Well, if you look at their stats, okay, who believes the Chinese stats? Yeah, but they've got deflation. They've been struggling for deflation, particularly products, for ages. Okay, and so they've got huge. I mean, the problem with their system is that they've built factories like left, right, and centre and infrastructure, and it's just not being utilised. So when it comes to cosmetics, they've got these enormous, great big sheds. Okay, and I bet you, like, they're only utilising 25% of it, and so the marginal cost of selling extra, they just play it on that gross margin. If they make any percentage of gross margin contribution, they just push it through because it employs people. So they've got deflation, which says to me their prices aren't going up. Okay, and therefore with the currency devaluing, then in theory that should be a benefit if you're buying, as Warpaint are, in sterling. I mean, you know, just doing the maths, but it is only temporary though, because everybody else gets those benefits pretty quick as well.
Yeah, interesting. And I know we had a lot of chatter about Elf, didn't we? A big competitor called Elf, which I think made people nervous about Warpaint, I think. But I mean, it's a huge market though, makeup internationally as well. So I would have thought Warpaint's 100 million on annual revenue is probably defensible, but who knows? But yeah.
Okay, good. Let's switch sectors. Let's go to media and advertising sort of agencies. We had a really brilliant chat to the co-CEOs Ollie and Theo Green. They're brothers basically of Brave Bison, and they gave us the sort of another. I know we use it a lot, a masterclass in all things sort of marketing agencies, and their shares have done brilliantly. In fact, just give people a bit of sort of like context. I think they took this company over when it was a market cap of around about 4 million, I think he said, or 5 million, and now it's a market cap of 80 million. And it's got a number of big shareholders. Lord Ashcroft 25%. It's also got News Corp. Anyway, what's your take on the business? If you're going to go into media and advertising, what do you think about Brave Bison?
Oh, I've liked this for a long time. I've been very positive on it. I was just counting up 11 times in the last year. I've reported positively either green or amber green. I really like it. I've heard really good things about the Green brothers. So I was really looking forward to this meeting that you set up, and it was fascinating. I think one couple of the things that came through to me from this is that they really know what they're doing on the acquisition side. You know, it's a buy and build thing. And they, as you say, they gave us a masterclass really in what they do and how they do it. It was really impressive. They're not overpaying for things. They're only buying things where they've got a clear angle on it, what they can do to change the business, to add value. I think this mini MBA acquisition that they did they gave us some color on that. That looks to have been a really good deal. I think they bought it from Centaur. That sounds so it's not just an advertising and PR group. About half the profit is coming from e-learning, which is the mini MBA product, which, as I say, looks a cracking acquisition. And they seem to have pricing power as well. They flagged, well, look at our operating margins. Actually, we're not like WPP, just kind of reselling advertising. We're really selling that high level creativity that you don't get from the AI stuff, because you obviously grilled them on AI. I thought it was all very, very good. I love as well their attitude that, look, we're going to meet or beat. We set the forecasts to the market deliberately at a level that we're confident we can at least achieve those. And why can't all companies do that? It seems so obvious, doesn't it? So no, I was tremendously impressed. I only wish I'd bought some shares in this, because I've been really bullish on it for over a year, and I didn't buy any. Isn't it silly?
Yeah, they're sons, aren't they, of Michael Green, who's got a lot
That's
of
right.
experience in this area. I mean, their dad is basically, he started off Carlton Communications, which then went into Granada and ITV and all this sort of stuff. So they're a chip off his block, and these guys have really got the bit between their teeth. And I think when it comes to sort of hunger to actually get this business much bigger and really singing, they're right on, right on the page, and they've got a lot of shares themselves. So they're motivated both just because they want to prove that, they're doing, to get the business, really singing, and they've obviously got the financial incentive as well. So if I was going to back a winning team in media agencies, then I think these guys, and I think these are the guys, the ones I do, and also I think that your point is really brilliant. In fact, that most of their consultancy is really high level, which is effectively relationships with the marketing director of big companies like New Balance and people like that. And it ain't going to get that is not going to get AI'd out, because there's no way New Balance is going to put a marketing budget of about 100 million euros each year with these guys unless they absolutely trust them what they're doing. So I was very, very impressed with both of them.
I was. And what I liked as well is they're not sort of Nepo babies, or they're not dining out on their father's reputation. That kind of came out as an aside right at the end of I think they didn't say it, but my inkling is these guys are doing this under their own steam and are proving that they can actually they're not riding on the coattails of their father at all. They are doing a brilliant job, and they're very capable, I think, very, very. And there was a real kind of, particularly with Theo, I think I could see quite a steely determination with him. Do you know what I mean? Yeah. And Ollie seemed a little bit more laid back, but no, I think they're great guys. And what they've done so far in such a difficult sector as well, and such difficult macro, I think, you can get a buy and build really humming and work. Every deal has added value. They got Lord Ashcroft in the background with his checkbook at the ready, which is great because it means they can make quite audacious bids for things, which they've already done several times. I mean, a couple of big deals didn't come off, but, I think this is an exciting thing. And the deals they're doing, they can get them cheap, because the sector as a whole is really under the cosh. As we know, last August, I think it was, several of them put out big profit warnings, marketing companies, just saying the customers have locked away their checkbooks. So there's deals to be done on cheap multiples, and then they can take out a whole bunch of duplicated costs. So I think it's very, very exciting, this. I mustn't get too carried away, though. So I'm hoping for a dip. I want the shares to drop so I can buy some.
Yeah, they do seem to be the real deal. Let's move to gambling software. We've got Gaming Realms. I think they came out with some results or a trading update. Got Tony asking about it because it was quite positive, I think, the trading update. But they came out, they then slipped out, apparently from the brokers, a bit of a profit warning. What was your take on it? It looked a bit naughty, actually, but.
Yeah, they're on my naughty step, which is a page on my spreadsheet where companies put out a nice cheerful RNS saying everything's fine, and then slip out a massive profit warning through the broker on the same day. It's outrageous. I mean, if they did that in America, they'd end up in court. So I'm very, very annoyed about this, actually. We've dropped it 2 notches, which is unusual, from green to amber, because, you can't do that. Yeah, through Canaccord Genuity, they dropped the calendar 2026 forecast by almost half, down by 46%, blaming the budget. I think basically the increases in the UK budget. Well, the company put out this RNS banks basically saying everything's fine. So I mean, that is dreadful. So the result of that now is we just don't trust them, and we wouldn't touch these shares. So they've blown it as far as I'm concerned. Not interested. And we did flag the profit warning to our readers at 10 to 8. And of course, a lot of people wouldn't, because we don't just read the RNS, we join up the dots with the broker research that comes out first thing, and that's really, I think, pretty much a unique thing about my Substack. And so we did flag this to our readers, so several of them sold on the opening bell, and actually the shares went up 4 or 5% on the opening bell. So our readers got out, and then by the end of the day, it was down 7% as the news trickle. Why do companies do this? Because all they're doing is deceiving people for a matter of a few hours, and then when everybody's actually got the truthful picture, everyone hates them and doesn't trust them. You know, they've done enormous damage, I think. You know, tell me if I'm wrong. You know, if I've got
no,
something wrong.
you're right. What was the reason for the downgrade? Was it the tax? Was it in the UK or something?
I think so. Yeah,
the new
yeah.
gambling tax.
I didn't read the broker note myself, but you just can't do this. You can't sneak out a 50%, nearly 50% profit warning through a broker and not reveal anything about why that's happened in the RNS. An absolute no-no. So as far as I'm concerned, it's more or less uninvestable now.
Yeah. Okay, good. We've got a final. We've got Timmy's asking about a new IPO that I think you had a look at, actually. This is Power Pro, which I think that does diagnostic. US company does diagnostic devices for garages and auto centers when somebody has cars. You know, electronic car comes in and you don't know what the problem is, so you can diagnose what the actual issue is to get it sorted. What was your quick take on it? It's only just recently come onto the market, I think.
Yeah, it was. Well, on the RNS, as you know, we pour over it, the whole thing every day. I saw two names that I hadn't spotted. One was I can't remember now. So, an AI PR company or something. I didn't think much of that. But the one I also looked at Power Probe, and I did write-ups on both of these. And now this one is actually quite good. PWR. It's based in America. It makes those devices that you see people fixing cars having, you know, with an electrical probe on it, basically to test the circuits and whatever. Seems to have some quite good pricing power, decent margins, good growth from new product launches. I would say to people, have a look at this, and it raised 8 million net in IPO money. To no selling shareholders. It raised the money to expand. It's basically reshoring. It wants to reshore production back to America. It's currently made by third-party factories in Taiwan, so you've got obvious risk there of and tariffs and so on. So my only real to flag up my only question mark on Power Probe is that you've got the execution risk of they're going to have to basically build a factory, kit it out, train up all the people pretty much from scratch, and it's going to cost more, isn't it? It's bound to cost more to make the products in America. So you could see maybe margin erosion, execution risk from the reshoring side. But that was really the only, I'm just flagging those as potential risks. But in all of the respects, this looks a nice business, actually. It's been around a long time. It's been around about 25, 30 years. So yeah, Power Probe, I would have a look at that. And I think it's reasonably priced. Not a bad quality IPO at all, actually. We need some more of these. You know, I would flag as well the advisory fees on these last two IPOs are ridiculous. I think one of them, 29% of the money raised went to pay the listing fee. All the advisors, you know, it's crazy. We're never going to see AIM rebuild, or the market generally, if we have all these roadblocks to letting companies float. They need to just slash the administrative burden, let companies float cheap and simply and without all these, you know, reams of stacks of paperwork that nobody ever bloody reads. It's a ridiculous market, the UK IPO market, but signs of life that we've got one or two decent IPOs, because we really need to refill the hopper, don't we? I think Allenby said that about almost 10% of AIM delisted last year or was taken over. So we badly need more of these. But Power Probe is a good start. I think it's quite good.
What sort of valuation is it on? Do you know? Is it when it's IPO
60 million, I think.
No, PE. What would be the sort of PE if you? I
mean, it's about 13.
About 13. Oh, okay, yeah.
Yeah, and it's got a solid balance sheet with net cash as well. And nice growth. It looks growth at reasonable price. But as I say, I'm not sure about how the reshoring of production will go. Yeah. So yeah, it's pretty good.
Just on that broader issue, when it comes to fundraising, okay, and you got those fees you pay, then if you actually look at the minute detail, and I haven't looked at it with Power Probe, so I don't know, but a lot of these tends to be, if it seems really rich, what happens is that they IPO to effectively refinance the debt or convertible or whatever like that, yeah. And what happens? If
that wasn't the case for this one, yeah,
wasn't it? Okay, but it can be. And so what happens is that. What happens is that, first of all, management team can get a big bonus having worked on an IPO for 2 years. They get like, you know, a couple of million quid themselves, about, you know, the management team, just as a thank you. It's pretty good money to have. And then the other thing is that if you effectively refinance a debt early and it's high interest, then there'll be a fee on that as well. So it isn't necessarily the big fees isn't necessarily all going to brokers and to people like that. It can go to the actual company in salary, bonuses, one-off, or a debt provider, which is effectively the private equity guy who owns it. He gets a big fee for doing it. So you'd have to look through it in granularity.
Yeah, I do. I mean, with these, when I review an IPO, I read the whole admission document. I mean, you can miss out whole blocks of it, but I always do that. And I agree with you. The ones where they say, "Oh, the company's raised, £50 million of new money," and you look through the admission document, you can see that it's the historic balance sheets loaded up with private equity debt, so that a lot of them cash is not the company, it just goes in and out. So you're quite right to flag that. But I always check all the fine print. And with Power Probe, it was a really nice, clean IPO. There was no existing debt to speak of, and it's it looks nice and clean.
There was no early redemption fee on anything like that. No, that's the point.
No, there was no. It's quite well funded. I mean, you do have the ask the question: why is a smallish growth business in America listing on the UK market? You know, it's a bit weird, isn't it? But
it can't list on NASDAQ unless you're 500 million. Unless you're 500 million, it's pointless. You don't get any liquidity in the States. I mean, they complain about liquidity in the UK, but you're going to get no liquidity unless you're probably a billion at minimum market cap in the States.
But in a way, it's quite encouraging, isn't it, that a reasonably decent, profitable growth company in America is listing in the UK? I mean, I think that's quite encouraging. But I couldn't see anything. I went through the whole admission document, and most of it, and I didn't see any red flags. Whereas the other thing I looked at, I wish I could remember the name of it now. I think Pathos.
Communications.
Yes, I looked at that. That's got quite a few red flags. So see my report, whenever it was, a day or two ago, where I went through both companies' admission documents. It was Monday, I think. I did an IPO special on Monday. So of the two, I wouldn't touch Pathos, but Power Probe, I think looks worthy of research. Yeah.
Yeah, well, maybe some green shoots in the IPO market. I mean, we can always hope that Elon Musk might list SpaceX in the UK, 1.5 trillion.
Blimey. Do you reckon?
Or even OpenAI, $1 trillion would be nice, wouldn't it? Come back to the UK. No chance. Zero. Less than zero.
But I quite like the idea of London as a market for smaller and also mature value type shares. I don't see anything wrong with that. And then let the mega rock star AI stuff, let the SpaceX and have NASDAQs for that. I don't see a problem with London being differentiated for maybe more staid companies, but particularly with AI and all these shenanigans with the prices. There was something John Authors put out today, actually, in his a very, very good daily email, where he was saying there's actually been a rotation in the US market out of growth companies, and value shares are coming back because people are saying, well, actually, I wanted to own a railroad because that can't be disintermediated by anybody. Well, unless somebody builds, I don't know, a hover thing or something. But you see what I mean? He was actually saying value type, traditional old economy, if you want to call it that, shares. There's actually a bit of a rotation coming back into those in the US, which is very good for us because we look at a lot of stuff like that here in the UK, and it could come back into fashion maybe.
I did see another chart though when you looked at the earnings estimates for 2026. Okay, and if you started it on the 1st of April of last year, i.e. Liberation Day, okay, then the estimates for the Mag 7, okay, this is the broker estimates for EPS for 2026. So we're up about 30%, 25% from. So they've really rocketed, gone up. And then you look at the aggregated EPS forecast for 2026 for the 493 other shares in the S&P 500, not Mag 7, and it's zero. It's gone nowhere.
Is it really?
Been totally flat. Yeah. So when you're looking at actual, yes, it might be a rotation just as a valuation, but the engine of earnings growth is not there yet in those other shares.
Interesting.
Overall, it is.
Yeah, interesting, very interesting. But there was also the guy, wasn't there, from The Big Short, I think it was, who put out an interesting report recently saying that the Mag 7, are spending these vast, trillions on AI and data centers. He reckons that they're understating the depreciation charges, and when you start to put those massive depreciation charges through their P&Ls, those earnings could actually might be overestimated, possibly. I don't know, but I haven't looked into it. I'm only passing on secondhand info there.
Yeah, good. Okay, well, thanks everyone for all your questions. Sorry I haven't been able to get through every single one. It's been another really busy week, as you can see. And thanks again for all the comments and insights there, Paul. The show, same time, same place, same channel next Wednesday. So thanks again, Paul.
Thanks, Paul. Bye, everyone.